leverage and interest can do good and bad. And so when you've got a market like anything that was not the last 3 years, where you've got single digit interest rates, really sub 5% interest rates, then your cost of debt is far cheaper than the cost of private capital. And so let's say that you're running a equity stack that you're giving a 10% preferred rate of return, and you're then splitting profits 80-20 over and above that. Okay, fantastic. Well, if you've got debt that is 5% and you're buying an asset that is going to produce with 60% leverage, that's at 5% debt versus 80% leverage at 5% debt, you're going to get a lower cost of capital on that extra 20% going from 60 to 80% leverage. Because now instead of paying the 10% pref and splitting 80-20 on all the profits, you're using cheaper cost of capital, i.e. 5%, all the way up to 80% of the capital stack. And so now you can use less expensive money to generate a higher overall return. However, in the flip circumstance, when you've got maybe a variable interest rate loan or you've got high interest, then you want to use less leverage because that interest is going to cut into more of your overall profits. It's going to cut into more cash flow because you're going to use more cash flow to cover your debt service, and or if you're buying an asset assuming negative cash flow after debt service, which a lot of California investors do, or New York investors, where they know that the value of that dirt is going to appreciate faster than the cost of their debt, but maybe the asset doesn't cash flow enough to cover the debt. Well, then they'll raise enough money to cover the negative debt service long enough for them to hold the property long enough and then turn around and sell. So if you're using up more of your cash flow on debt service, that's obviously going to eat into your returns to some extent. And so it's, a levered IRR versus a non-levered IRR. The levered IRR is always going to be stronger. That does not mean it's less risky though. A levered return where you're using cheap cost of capital with leverage comes with pros because you can generate higher returns, but the cons are it can also negatively impact your investment when interest rates get too high on like a variable interest rate loan.